Hello everyone and welcome to Step Into My Office, Commercial Property Executives podcast series that tackles all things office and flex office related. Join me and industry experts in the field as we take some trips across major markets and delve into investment strategies and opportunities in the sector. I'm Olivia Bunescu, Senior Associate Editor, and in this episode I'll discuss with Marcel Arsenault, founder and CEO of Capital Solutions, a company with more than 40 years of experience and roughly $5.1 billion in acquisitions. At a time when the firm is targeting distressed and high-yield office opportunities, Marcel explains why office is an operating business, not a passive asset class. We discuss the Denver office market, financially distressed buildings, lender pullbacks, tenant demand, and what recovery could look like nationally. Thank you very much for accepting my invitation to Step Into My Office, the podcast series where we discuss everything office related. In today's episode, we will discuss the dynamics of the Denver market, more specifically, buying distressed office buildings in the Denver market and Capital Solutions portfolio and ethos.
Wonderful.
I'll start with the first question. When you look at the office market today, where do you think we are in the cycle? What are the main trends you're noticing in the space?
Thank you, Olivia. The market appears to have bottomed approximately 6 to 12 months ago. It may be a false bottom or it may be a permanent bottom. The values are exceedingly attractive. We're buying office buildings in the Denver area and actually Chicago, Dallas, Connecticut, New Jersey, all over the country. And we're getting over a 12 cap rate. And then I've noticed that lately office values seem to be recovering a little bit. For example, we went out and we bought, I think it was 5 buildings, 5 properties. Some of them were multiple buildings in one project. And we got a broker's opinion of value. We've already gained on those projects over 30 million in value. So it would appear that the worst is behind us. And it resulted obviously from the work from home mandate where a lot of companies were giving up space. So it would appear at this point that it may be choppy and there may be another bottom, but at this point, there seems to be a mild recovery underway.
And what do you think people still get wrong about the current office environment nationally or in the markets you're active in? What are the most common misconceptions?
Office is an operating business. It's not a passive piece of real estate. In a good market, real estate can be passive. In other words, when the demand is very high, and lenders are at the table making loans, generous loans, then it looks like it's a foolproof business. You just buy and the tenants knock on your door, you fill your building up, you make plenty of cash flow, and you mistakenly think that it's you when in fact the market is rising. So that's a misconception because in our shop, we know that we have an expression, we call it winning the leasing wars. We know that it's highly competitive, it always is. And even in a good market, you want to service your tenants, you want to be all over it, you want to give them good tenant finish, allowances, you want to make sure that, you service the property very well. It's almost in a way like running a hotel. Fortunately, I come from the manufacturing business, so I'm not naturally a real estate guy. I'm more of a guy that knows how to meet a payroll and run a business and have customers. So I think real estate, the biggest misconception is that real estate is passive. It has aspects of being passive. In other words, over a long period of time, values usually go up at the rate of inflation, maybe a rate of inflation plus 1%. So to use a sailing analogy, you have the wind at your back, but you shouldn't take that for granted. It's an operating business. You have to be all over it. And that's the biggest misconception is people treat it as a passive business when in fact it's like running a restaurant or hotel or something like that. You want to really manage it. And if you do, then you're going to be successful. And if you don't, then you'll be successful in good times and get a lot of problems in difficult times.
And is there any disconnect right now between how office dynamics are framed, especially in media, and what you're seeing on the ground? And if there is, where do you see it? Where do you see the biggest disconnect?
I think the biggest disconnect is at the lender level, that lenders have gone from piling in, let's say in 2019, 20, even 21, in other words, being there for borrowers to make them loans that were, let's say, 75% loan to value, 80% in some cases. Fortunately, we're very analytic and we knew that it had been too good for too long. So in 2018, 19, we began selling our office properties and we sold 26 of them. And I thank goodness for that. We still kept about a dozen. And the disconnect was in the mortgage market. And that came as a result of COVID. In other words, the work from home spread. And a lot of tenants then believed they didn't need as much space and started giving it back. So in,
Mm-hmm.
2022, 23, 24, even 25, part of 25, they were given space back. This panicked the lenders. And all of a sudden, huge numbers of office buildings became underwater. The first office building we bought in Denver had been purchased by a very large pension fund out of California, one of the largest in the country. They paid over 80 million for it and they
Mm-hmm.
sold it to us for 22 after holding it for 9 years. So instead of going up, it went down. And the reason I knew they would sell it for 82 is because that was the amount of their loan. And they just wanted to walk away from their equity. They didn't want a black mark on their record. So the disconnect, frankly, was on the lender behavior. Lenders went from piling in to piling out, taking a lot of properties back and being determined not to make an office loan. The deal that I was telling you about, I'm probably one of the strongest borrowers in commercial real estate because I have what they call a fortress balance sheet, a lot of cash, very high net worth, and over 41 years, we've done over 400 commercial loans and never defaulted on one. So the banks uniquely like our company, and we
Mm-hmm.
were able to get loans, but I had to sign on the loans personally. The banks trusted me, but they only trusted me. They would only make a loan if I personally guaranteed it, which I was fine with because, I'm not going to buy something if it's going to be a problem. So, if we buy something, we work very, very hard to make sure it works. But the disconnect was lenders. First, they pile in, they don't see a problem. Then afterwards, they pile out and you can't get a loan. And we were probably one of the few companies in the country that was able to get loans on distressed office buildings. So lenders piled in, then he piled out.
And starting from that, this leads me to my next question. How do you separate real opportunity across your portfolio? And if you can touch on the company's ethos a little bit, especially what gives you the conviction to step into parts of the market that many investors are still avoiding?
We've been doing this for 41 years. And as my wife says, if you do something for 41 years, you should get good at it. And
That's really
yeah, and so we treat every building as an operating business. So the first thing we do is we avoid all of the buildings that we think are not going to be easy to lease. We talk to the tenants, make sure the tenants like the building. It'd be like buying a restaurant. If you wanted to buy a restaurant, you want to talk to the customers and make sure they love the restaurant. And then you want to figure out how you can run that restaurant better. And so the first thing we do is make sure that we buy the right property. Our team, we have four acquisition teams, depending on a little bit how you count them, but they're all over the country looking for deals. We select what's called the B plus or the A minus buildings. These are
Mhm.
buildings where there's a flight to quality. The tenants like the property. It's got good amenities. It's well maintained and has a good reputation, a good location. We avoid the C properties. I used to own a number of C properties. I sold one property. It was a 27-story skyscraper in Denver. We called the Denver Tower, the Colorado Tower, rather. And, we sold it right before the Great Recession to a Norwegian fellow. And he got an offer on it, a very high offer, and his partner didn't want to take the offer. That was about 4 years ago. Didn't want to take the offer because they had just raised a fund and they didn't want to give the money back. They would have made pretty good profit. They ended up selling that tower for less than 10% of the offer 3 years later because it was a C property and it wouldn't attract tenants. I talked to the new owner and he's going to convert it to apartments. And it's going to, his conversion costs are very, very expensive. So it's tricky, as you know, converting office to residential. But in our shop, we want to make sure that we buy the right property and we want to make sure that we understand exactly what our business plan is. What kind of tenants do we want to attract? How are we going to win the leasing wars? It's highly competitive out there. And so, you have to select things you can improve, and then you have to work very hard and to make sure that you're winning the leasing wars.
Is that what distressed office buildings mean to you in practice, or how would you exactly define it if you had to define it?
Yeah, that's a good question, Olivia. We define it as financially distressed, not operationally distressed. So, in other words, they're upside down on the capital stack, and the lender is fighting with the owner over the default. And we know that, and the owner doesn't want to put money in it because, if they paid 100 million for the property, their loan is 75 million, and it's only going to sell for 50 million, which is the kind of numbers of, maybe 45 or 50 million, then there's no incentive on the owner's part to put money in. And so the tenants, get disappointed in the owner because he or she isn't investing in a property. So we call that a financial distress. The property is a good property, it's leasable, but for the last 2 or 3 years, nobody's been investing in it. And when we get in, we upgrade the lobbies or we do whatever it takes to win the leasing wars. And so those are financially distressed properties where the capital stack doesn't work, and we have good capital and very loyal financial partners that have joined us. And like I said, our banks we work with 35 banks across the country to make loans, and they're uniquely supportive.
Is the same definition applied to the Denver office market, or are there any other particularities when you're evaluating a distressed office opportunity, specifically in Denver?
Denver has out-migration, so every market is different. And Dan does our research and helps me with the macro. We look at markets very carefully, and we want markets where there's growth potential. But we're willing to take on properties where the market has negative growth if we believe that we can operate the property much better than our competitors. So I think Denver is similar to most markets. Every market's different. There's more job growth, for example. We own a couple of properties in Dallas, and there's more job growth in Dallas than there is in Denver. So Denver is more of a fight for tenants. Dallas is still a fight for tenants, but it's a little, if you have a nice property in Dallas, your leasing momentum is a little better because the companies are growing in Denver and adding in Dallas, and they're adding employees in Denver. There's a small amount of shrinkage going on. So Denver has out-migration, like some of the Florida markets. So you want to be a little more careful buying in a market like Denver. It's our hometown, so we know Denver pretty well. We probably own 25 or 30 office properties in Denver over the last 40 years. So we have a hometown advantage in Denver, so we like to buy property there.
Where exactly do you find most opportunities there, whether it's types of buildings or neighborhoods?
Neighborhoods is really important. The type of building, like I said, has got to be a B plus or A minus. We don't go for the trophy properties. For example, Cherry Creek is a very fancy neighborhood in Denver, and the cost of those properties might be five, six, $700 a square foot. We'll go to the next tier, like the Denver Tech Center. which is very attractive with a lot of amenities. It's not quite Cherry Creek, so it's not, $40 a square foot market. It's maybe 28, 29, $30 square foot. So we like those neighborhoods. We're watching Boulder. We think that Boulder has not yet collapsed, but probably will. So values in Boulder are going down because jobs are disappearing in Boulder as well. We know one neighborhood from another, and we prefer the up and coming neighborhoods, the ones where our leasing job will be a little easier. And again, it's more about the property than the neighborhood, because every neighborhood has jobs and every neighborhood needs office. But, the better neighborhoods will do better and they'll recover faster.
Do you think that that is the determining factor for the buildings that are best positioned to compete for demand, or is there anything else?
Well, I think there's a variety of factors. The demand improves the fundamentals. In other words, if there's demand, it's easier to win the leasing wars and to fill your building up. Most of the buildings that we're buying are about market occupancy. In other words, about 70% occupied, maybe sometimes 55 or 60% occupied. They cash flow very well, ironically. In other words, we're buying them at a 12 cap, over a 12 cap. And so there's very good cash flow day one. The reason they're selling at such attractive prices is nobody can get a loan. I've had more than one bank tell me that we may be the only customer in the country that they're willing to make a loan on, because there are plenty of companies that are larger than our company, but they're non-recourse. They won't stand behind the deal. And so the last thing a bank wants is another property that, where the borrower doesn't want to pay the mortgage. And in my case, I'll do it. If I have to write a check to pay off the bank, I'm happy to do that. So that's one of the factors, is the cash flow. Cap rates are another very important factor. So the cap rates right now are very high because lenders have a lot of properties they're trying to get off their books. And so as a result, if the lender is trying to sell it, or if it's a short sale, they have to accept a very low price. That will change. Cap rates usually revert to the mean. A 12 cap rate is unsustainable. Cap rates are already falling. Like I said, we're past the bottom, and we're in a sort of a slow recovery. So cap rates are very important, which leads me to the final thing that is probably the most important part in our business, which is the lenders. Once the lenders start returning to the table after they finish selling all of their distressed real estate, they'll go from defense to offense, and the lenders will come back to the market and they'll make loans, more generous loans, and then people will start buying, and that will drive down cap rates, which of course drives up values. But like I said, the most important factor, we don't control cap rates, obviously, and we don't control lenders. We just understand that their behavior is cyclical. Sometimes they want to lend, sometimes they don't want to lend. And, in this business, it pays to be contrarian. But in order to be contrarian, you have to be able to weather the downturn. You have to be able to have the confidence that you're going to be able to fill your buildings. We have a lot of veterans in our company, and as a matter of fact, we're looking for a few executives that can help us in our expansion. So far, in the last 18 months, we bought 560 million of office buildings, and we think we're about halfway there. So we want to continue to buy distressed office, and it's a people business. And so we want to attract the right people and right executives that can help us win the leasing wars. And that is perhaps the most enduring factor, is in any business, you want top talent. And that top talent has to nurture the business, love it, make it work, just like running a good restaurant.
The last guest I had on the podcast was the CEO of a co-working company in South Florida, and she
Right.
used to work in the restaurant business. So this is the second
Right.
time in the past 3 months that
Uh,
there's this analogy with the restaurant
oh,
business.
well, I think it's running an office building is more like a restaurant than we like to think. You got to keep your customers happy. You got to give them good value, and make them loyal, and treat them right.
Yeah. That's right. I have a few more questions about distressed office buildings. In your opinion, besides you mentioned the C building types, is there anything else that separates a distressed asset that can be turned around from the ones that are probably better left alone?
In a tough market, and office is in a tough market, there's not much you can do with office buildings that are obsolete. In other words, they don't meet the tenant's current requirements. It'd be like a rundown restaurant that takes a lot of money to turn it around in the wrong neighborhood. So frankly, there it's more important to pick the properties that you can operate, and some of them are probably unfixable.
Mm-hmm.
And unfixable at any economic cost. So those buildings, some of them would be converted. A number of them are going to be torn down. It's already happening where the properties are, maybe only 20% occupied or 30, only a few tenants serving out the last years of their lease. There's not much hope for those buildings, and that's a big part of the market. So once those buildings are mothballed or torn down, then the market will recover. We purchased a beautiful office building in Cincinnati, and it was, one of the best office towers in the city. And we noticed that in that market over the last 10 years, a lot of the B class office buildings and some of the A minuses had been converted to residential. And so that turned out to be a pretty good market because a lot of the competition had been brought offline, had been converted. So unfortunately, I think there's a death sentence for some office buildings, and there isn't much that can be done. Not economically. You can pour infinite amount of money at anything, I guess, but it doesn't make sense. So I think there are some office buildings that are dangerous at any cost. You can't give them away.
And once you mentioned briefly earlier about renovating the lobby, once you acquire a distressed office asset, what are the first moves you think matter most in repositioning it? And if you have any examples from some recent purchases you made in Denver, for example?
We purchased two sets of buildings very close to each other, maybe about a block away. One of them had a beautiful lobby, was financially distressed. In other words, the lender was taking a hit and wanted us to come in, or a buyer, any buyer, to come in and take it off their hands. There wasn't much we had to do with that. Frankly, the lobbies had been renovated. It was beautiful. The tenants loved the building. So we just bought it at a very, very attractive price, and we're making good money on it. The property next to it was a bigger property that was tired. It needed new lobbies, so that really helped a lot. And then we also built out a lot of spec suites because a lot of tenants don't they don't really have time. If you're an engineering firm and you have 20 employees, you don't want a year for the landlord to get a building permit and to build out your office. You might only have 6 months on your lease, and you want to move in 6 months. So what we do is we try to get ahead of the game on almost all of our buildings by doing quite a bit of spec suites. So we'll do the lobby. If we think the elevators need upgrading, we'll upgrade the elevators. But most of it is, I call it hand-to-hand combat for the few tenants that are out there. Most of it's just hard work, making sure that you attract the tenants and give them what they need. And they want a deal. Everybody wants a deal. And so, that's is to make sure that when you're buying a property, that you have the means of attracting a tenant, you have the budget. We're doing sort of hoteling, or in some of our buildings too, where we'll have a nice area, common area with coffee and a nice cubicles where people can make private phone calls, and a gathering space. So we try to not just do spec suites, but also make very attractive amenities within the building. Like in floor 4, or we'll in a property we bought in DC, we'll do a patio on the roof so that there's good views and nice amenity. It's a combination. Every building's different, like every restaurant's different, and you have to understand, what you're doing and be dedicated and make sure that you know how to run the business. But so I wouldn't say there's one size fits all. You know, in Denver, like I give you two examples. One was quite a bit of capital expenditure, and the other was pretty nice the way it was.
And to conclude our episode, what are your predictions for the office sector, both in Denver and nationally?
Pretty much the same for Denver National. I would say there's two scenarios. I'm frankly pessimistic as an individual. I'm always worried about the future. I'm an old molecular biologist, and believe it or not, I was worried about pandemics for years. And then when one arrived, it was kind of okay. It didn't quite play out the way I thought it would. But so the prediction is a slow recovery. That's our base case. In other words, as tenants work from home, most companies are calling their employees back slowly. So a slow recovery. And then in a lending environment, also a slow recovery as lenders over the next 2 or 3 years sell off their remaining distressed assets. Then they're going to come back to offense and they're going to start making loans. Once that happens, cap rates will be going down. They're already going down a little bit, and there'll be a nice recovery. It might take 5 years, it might take 10. The second scenario is what we call the recession scenario, where there could be a bit of a false bottom where lenders actually get back more distressed properties than they have now because the tenants suffer in an economic downturn. It's possible that we could rebottom again next year or the end of this year if there's a recession. And then, of course, on the horizon is AI. And AI is something that, we all have to be mindful of. It's going to destroy a lot of jobs. Everybody knows that. But I think in addition, it's going to create jobs. For example, in the medical field, if we have a lot more abundance, we're going to spend more on care and more on restaurants. So it's a mixed bag. But one thing that is universal all times, and good times and bad, is taking care of your customer, running your business, winning the leasing wars. And so I think in our case, we'll recover more quickly and more certainly than our competitors because we were ready for this, and we want to pile in. We're calling this our third rodeo. I was here during the savings and loan, made a lot of money buying distressed office. And then after the Great Recession, same thing. We sold a lot of our property before the Great Recession. We saw that coming and then kept our cash and then piled in. And so this is our third rodeo. So I think there'll be a good recovery. It'll take years, but we're patient, and in the meantime, we'll run our business and do the best we can.
That's great. Thank you so much. Is there anything else you'd like to add?
Yeah, there's one other thing, which again, I guess to summarize, this is a people business. It's not about buildings, it's about people. The best people always win. The buildings are just inanimate objects sitting on the landscape, right? They're steel and glass and stuff like that. And so I think I owe a lot of my success to the idea of understanding what the business is, that it's really about people, not about buildings. And then understanding that what I need to do is surround myself with the best teams possible. We just sold a business on Friday in Texas, an oil services business for a very handsome price. And frankly, it was people that made it. We had great people that knew how to run that business, and they're going to do very well for themselves. They did very well for us as investors. And so all businesses really revolve around the right people. And if you have the right people on your team, you're going to succeed in good times and bad. So that's sort of the thing to keep in mind. It's not a passive business. It's all about people. The other thing, Olivia, that I might mention is part of our team members believe that we should start a distressed office fund. So we're looking into that pretty seriously. We have a couple of investors that have encouraged us to pile in and to start a fund. That's one thing I didn't mention is we're looking into creating a distressed office fund.
Thank you very much. And thank you very much for accepting my invitation to step into my office. This was a great discussion.
Thank you, Olivia. Take care.
Thank you for stepping into our office. Stay tuned for the next episode of our series in July and feel free to rate this one if you've enjoyed it. For more commercial news, trend stories, and podcast episodes, visit cpexecutive.com. Have a great day, and we can't wait to see you in our next episode.